Okay, good morning and welcome back everyone to our Monday Trade Ideas research session. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay, and these sessions are here to help you start off your week on the right foot. Let's start with just an overall macro overview of what's happened in the past week and what we expect this week. Last week, we started off the week on a bit of a shaky footing, but the week really ended up being a fairly strong move here for equities. You had technology leading the markets higher with the NASDAQ 100 leading the equity indices. We saw rallies across the board. Small cap, large cap really were the two outperformers last week, but across the value versus growth spectrum, we saw a continuation higher, and we also have seen market breadth continue to improve as the equities kind of got back towards all-time highs. The VIX closed back around 15%, put call ratios fell, and markets really just went on the offensive across the board. We saw consumer discretionary, technology, consumer staples lead the markets higher here. And even home builders and retail started to outperform, while energy and healthcare were really the two sectors that created a bit of a drag here on the overall equity markets. This week, I think the biggest thing to look forward to is really the inflation numbers. I think this is probably one of the most important inflation numbers we'll get this year, because the economic data coming out from the past couple of weeks have reignited the concerns around stagflation, concerns that the economy is slowing down while inflation is ticking higher. We saw the recent recent PCE inflation number come out slightly higher than expected. We saw the labor market weaken substantially. Those two things in conjunction with each other are not a good thing for the overall economy. So whether or not the July CPI and PPI will surprise to the upside is going to be closely watched by market participants. You also get us reading on retail sales on Friday, so relatively light on the economic calendar. And also, in terms of earnings season, we're wrapping up earnings season, so not many reports. There's only three big reports this particular week: Cisco, John Deere, and Applied Materials. Outside of that, we're really looking at mid cap and small cap names in terms of the earnings calendar. Now, we'll go through our top trade ideas here for Monday, August 11th here in a few minutes, but just let's quickly review the charts here right now. This is the move that we saw here last week. We saw that market move higher here on the back of expectations that the Fed is going to lower interest rates relatively quickly in September, and also looking at two more cuts for the rest of the year. So we find ourselves basically back within spitting distance of all-time highs. And if last week's momentum continues, we will likely see a revisit of those all-time highs and continue higher. We saw that on the S&P 500. We saw that on the NASDAQ. The NASDAQ effectively got back to those all-time highs on Friday's close. As of today's open, we look like we're about to open up just a bit higher here above that to a new all-time high on the NASDAQ 100. You see the Russell 2000, the recent pullback here generated a bullish trend following continuations signal. So we expect small caps to kind of play a bit of catch up here as well this week. You saw the equal weight generate the same trend following trade signal here, buy signal here on the equal weight S&P 500, showing that market breadth is continuing to improve as the markets move higher. And the bond markets, HYG, continues to move higher here. Though I will note here, once again, this is the third time now where we continue to see higher highs in price that is no longer being sustained by higher highs in momentum. So this move here in HYG, high yield corporate bonds, is starting to look a little bit more exhausted here, which leads us to believe there's a higher probability of a pullback here for HYG. And bonds continue to decline here. I'm sorry, bond yields continue to decline. You have the 10-year yield back at around 4.27% on Friday's close. If we can start getting back into the low fours, that's really kind of what we're looking at right now, and I expect the treasuries to rally on the back of that. So overall, if you look at the equity markets, things are looking fairly strong here across the board for equities. And that is the same strength that we expect to see in equities this week. Now, looking at the ideas here for the week, that's why we are leaning far more here to the bullish side here right now with our ideas versus the number of bearish ideas that we are playing at the current moment. We've removed quite a few of the ideas over the week. So the first one I want to take a look at is a new idea we're looking at here, which is BDX, Becton Dickinson. They are a medical device manufacturer. They are the largest globally of medical devices. And this is a stock that has struggled quite a bit here since the beginning of May, being stuck in this, call it 165, 180 trading range that it's been in. And now it finally just broke out here above that trading range here at the end of last week on some strong volume. It was really on earnings that was the catalyst that moved the stock, and that earnings catalyst will target the gap fill here. To the immediate gap fill is the first upside target. We're really looking at a continuation to back towards kind of the old gap fill and the highs from the beginning of the year as our primary upside target. As you can see, BDX trades at a pretty substantial discount to the industry. It doesn't grow as fast in terms of EPS, but revenue is right there, and that's kind of what I favor more in terms of a metric, in terms of growth expectations, because it's easy to manufacture EPS growth. Revenue growth is much harder to do that. Net margins, as you can see, is a little bit lower than the industry. So that is what justifies a slightly lower than industry average valuation. But considering it trades at a 40% discount, it really represents still substantial upside here from where it's trading right now. And I think the earnings catalyst from last week is part of what's driving investor interest in this particular stock again, especially at these lower valuations. Another one I want to take a look at here is Lowe's, because with the recent Federal Reserve embarking on potentially 3 rate cuts this year, Lowe's and some of the home improvement and real estate stocks have seen life come back into it. You saw D.H. Horton, which is the home builder, outperformed the S&P 500 by a pretty wide margin here in the last month or so on expectations of potential rate cuts, and that has only continued as the expectation for rate cuts in September is greater than 90%. And looking at both October and December, they are both relatively high as well in terms of expectations of further rate cuts. So the fact that Lowe's, after bottoming, for what's the better part of this year and breaking out here above 235 last week, is what targets 265 here to the upside. That is the highs from earlier this year. That's our upside target here for Lowe's. And as you can see, Lowe's trades at a meaningful discount to the industry, even though it's expected to grow just as fast as the rest of the industry, and it's more profitable. So the fact that it trades at a discount is what reflects the fundamental case for Lowe's to trade back towards that 265 level. Not to mention, they've made some pretty good progress in their new loyalty program to attract professionals, something they've always lagged behind Home Depot on. And their just recent investment in AI, in producing AI-related marketplace for their e-commerce site, is an interesting play. And we'll see if investors start paying attention to this. Lowe's does report earnings here in less than 2 weeks here on August 20th. The next one I want to take a look at here is Amazon. Amazon, having recently pulled back here on earnings, is really kind of what we believe is an opportunity to the upside. We added this last week when it kind of fell on earnings. So far, the stock is doing nicely and starting to recover. Our upside target is 260 here to the upside. As you can see, Amazon trades at a premium relative to the industry. But if you look at growth expectations, if you look at profitability, we see pretty much industry leading growth and profitability across the board. So the fact that it trades at a premium valuation is justified. And you also have to account for the fact that there is some hype in the valuation related to AI. Amazon is very much in the race right now in building out AI infrastructure against Microsoft, against Alphabet, and all of the different players, and being AWS being the largest cloud provider out there, their investments are factored into the valuations right now. And some can say that these valuations are relatively high, and there's no doubt about that. But as we've seen with transformative technologies, valuations can get much higher. So, these currently valuations at 35 times forward earnings, given the fact that it is supported by growth and profitability, is something, in my opinion, that's acceptable, even though the valuations are still, at the moment, relatively expensive. Looking at Merck's healthcare, one of the sectors that's creating a bit of a drag here. So we'll kind of we'll monitor this particular opportunity as to whether or not this is one that will continue playing, because the fact that we were looking for this breakout here above 85, we haven't really gotten it. We'll see if we can get back up to 85 and break out higher here. If it doesn't move in the next couple of weeks, this is one that will likely take out from our list to look for just places where our capital is better deployed. Merck's, as you can see, trades at a pretty substantial discount to the industry, even though it's expected to grow faster and it's more profitable, which is why I like this particular stock. I think it's a really compelling fundamental or business case. But if the charts aren't moving, or if the markets aren't moving alongside with it, we have to know when to cut we need to know when to reallocate our capital to something that is performing. So this is one that's kind of on our watch list of potentially removing if we don't get a move here in the next couple of weeks. Block, big move here last week, but still the stock is still performing relatively well. We kind of liked it on the breakout here above 60. The stock has continued to move nicely here. It had a big candle here on Friday. We're still looking for continuation to the upside. As you can see, Block trades at a steep discount to the industry, even though it's expected to grow faster and it's more profitable. It should at the very least trade back towards this 25 times forward earnings, but right now it's actually trading at 16 times forward earnings, which is what represents such interesting upside here for Block. And we particularly like this particular stock going into into this particular week, where retail, both consumer and consumer discretionary and staples have continued to outperform the markets themselves. We have really liked Alphabet pretty much since it pulled back here to this trend line here. That's when we added this position. The stock has rallied really nicely since then. It broke out here again around a double top here, just shy of 200. Our initial upside target is 202. We're basically at our 202 target. That basically fills this gap here from February. So now that we filled this gap here, this is really where we can potentially make new all-time highs. And with Alphabet trading at 21 times forward earnings, I think that's more than reasonable to suspect that we could easily break out to new all-time highs and continue moving higher. Especially if you look at growth expectations, we're in line with the rest of the industry. That's great. But where Alphabet really excels is how profitable they are. 31% net margins versus the industry average is around 5%. So, look at Microsoft, look at NVIDIA, look at Amazon. They're all trading, 30, 35, 40 times forward earnings. Alphabet is the only one in this particular space that's trading at 21 times forward earnings. And that's why I think there's a substantial amount of upside available here in Alphabet. The next one we want to take a look at here is Charles Schwab. Charles Schwab is, we started liking this particular stock when it broke out here above this $82, $83 level here. And the stock has just continued to grind its way higher. It's just on its way higher. It's still trading at a low valuation relative to the fundamentals. We've basically, when we started looking at this, Schwab was trading at about 20 times forward earnings. It's trading at 22. So it's have a little bit of multiple expansion here. But if you look at the fundamentals, it grows substantially faster than the industry. It's more profitable than the industry, yet it still continues to trade at a discount. And that's why I believe there's still further upside here to our 108 upside target for Schwab. Micron, this is one that we added back to this position when it started to pull back here, and this is working out nicely for us. We kind of looked at that pull back to that 110 level as a reason to potentially get back into continuing this bullish trend. That looks like, we've kind of crossed back above the 20-day moving average. Everything is looking positive here. Again, the trends have turned green. So everything looks setting up relatively nicely. As you can see, Micron trades at around just shy of 10 times forward earnings, even though it has growth expectations that are more in line with NVIDIA's numbers. And net margins, at 18% is respectable. It's nowhere near the 55% that NVIDIA commands, but for a semiconductor company, or rather, especially a memory-based semiconductor company, which generally trades at low multiples, they have good profitability, good growth rates, and this is really where I think Micron is a really interesting play as an alternative for investing in kind of the more obvious plays in AI, like NVIDIA or Oracle or AMD. Those other names are where there's a lot of hype. They're relatively crowded names, yet Micron is one of the major suppliers of the memory chips that go into NVIDIA's GPU. So if you're expecting lots of growth here from NVIDIA, Micron is, in my opinion, a more compelling way to play that upside rather than directly investing in stocks like NVIDIA. And then looking at some bearish ideas here. The first one, this is a new one idea that we put out here, which is Philip Morris. Philip Morris, as you can see, in the last couple of months, have really started to kind of top out here a little bit here. The stock has traded range bound, broke out here above, call it the 175 level here. It broke out, but it just traded in a range for about a month and a half, almost 2 months. Started to break below that range here, rallied back, starting to rally back towards some of those levels. And that's really where we're looking for some downside from where we are. As you can see, Philip Morris trades at 22 times forward earnings, which is a pretty significant premium relative to the industry. It does grow a little bit faster, but because it's not as profitable, tobacco companies tend to be fairly high margin businesses, but Philip Morris has actually seen a substantial amount of margin compression here in the last few years. And because they're becoming less and less profitable, this is really where this particular business, in my opinion, is clearly in decline a little bit here, especially if you look at that trend quality, the change. Look at how green this thing has been pretty much all year, and just how that trend has deteriorated here in the last few weeks. So as it deteriorated and rallied back up to a prior resistance, that's really where the risk reward looks fairly attractive, looking at adding some bearish opportunities right now for Philip Morris. Now, I will say, in this market that we are in right now, that's been in a strong bull market, if you're taking short positions, you have to put them on with tight stops. And that's why we monitor all of our positions very tightly for when it's time to get out. We removed the Apple bearish trade, and we removed the Tesla bearish trade this week because they broke out above prior resistance levels. When they break above prior resistance levels, you have to cut shorts really, really quickly and get out of them and not stay in them for longer than you need to. But when shorts are playing out like they are for a couple of our other trades, I'll show them to you. That's really where you want to press those shorts. But when they're not working out, you got to get out quickly. Cintas, this is one that we'll monitor this week potentially for getting out. So basically, Cintas, similar to the Philip Morris trade, as you can see, trends were green, started to turn red here, and when it rallied back to prior resistance, that's when we thought it was a good time to take press a short. But as you can see, the stock is kind of trading sideways. It's starting to move a little bit higher here instead of moving substantially lower from where we are. The valuation is still incredibly I think the conviction is there based on the valuations. Look at that valuation, 46 times forward earnings. That's more expensive than Nvidia. Yet if you look at growth expectations, we're looking about 10% EPS growth, 7% revenue growth. That's pretty much average for the S&P 500. That's nothing to write home about. Net margins are decent, right? So you've got 17% net margins, but does that justify a 46 times forward earnings? I think that's really difficult to swallow, especially in a slowing labor market. And that's why I think some downside is potentially in for this particular stock. But if it breaks back towards 230, you got to get out. The timing on this just isn't right. CrowdStrike. This is one that has continued to press lower here since we've identified this as a bearish opportunity. We're looking at this breakdown below 475 as kind of the potential to get into a short position, and the stock is down to 424. Our downside target is 420, so we're basically at our downside target, and we will likely be removing it if it does hit that 420 downside target. As you can see, it's trading at 120 times forward earnings. I think there could be further downside here, but we'll kind of factor into the current market conditions as to whether or not we continue to press shorts on CrowdStrike. It's trading at 120 times forward earnings, which typically with growth rates like 20+% growth rates on revenue and EPS, that's to some degree justified, but they're not profitable. Their net margins are negative. And on top of that, a lot of times when companies are just becoming profitable, you see really high PE ratios because the denominators are very small. And that's a good explanation for why CrowdStrike is trading at a high multiple from an earnings perspective, but it's also trading at 26 times sales. So that I think is harder to justify. I think, when earnings are small, you have a propensity to trade at really high multiples of relative to earnings, but when revenue is growing relatively quickly and you're trading at 26 times revenue, that's where I have a big problem with this particular stock. And that's why I think even in this strong market, the stock has really struggled here in the last week, is because of the valuations that it trades at. So that is where we stand here for the week. As you see, this week is really light on the earnings calendar. You basically have Cisco, which is interesting, but probably not so much in this particular market. You have John Deere, you have Applied Materials. Other than that, there's really not much to see this particular week. So we don't have any earnings navigator this week. And on the earnings calendar, on the economic calendar, it's really CPI that we're really looking at here, which is the inflation read. The forecast here is 2.8. We'll see if we come in at a 2.8 or higher. And then we have the PPI on Thursday, and then retail sales on Friday. Those are really the only ones that we're paying attention to for this week. So with that covers what we have in store for you today. Hopefully this gives you a good idea of what we're thinking here for the broader markets and some ideas here for the week. I do see one question here about what happened with Pinterest. The stock is down a pretty substantial amount after earnings last week, which is why we're removing it from our buy list here at the moment. If Pinterest gets back into the $36, $37 range, that might be something we would reconsider at the moment. But on earnings, that's enough for us to say this uptrend that we were looking at is no longer intact. If it can get back above 35, 36, maybe we'll revisit, but not for right now. We think there are better places to deploy your capital. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.